Hello, I'm Farouk Jaffer. It is my privilege to welcome you to our latest quarterly market perspective. This video will cover what has changed in the market, why energy and inflation are back in focus, how leadership inside the stock market is shifting, where I see smarter positioning opportunities, how artificial intelligence continues to reshape investing, and finally, what all of this means for how I'm looking out for your portfolio. Over the last several months, investors were already adjusting to slower hiring, sticky inflation, and fewer expected rate cuts. Then the Iran conflict added a new shock by pushing oil higher and lifting bond yields. The markets are now pricing a longer supply driven disruption, not just a temporary headline event. That shift matters because it changes how investors think about inflation, interest rates, and overall risk. The clearest transmission channel has been energy. Oil surged, natural gas markets tightened, and shipping concerns started feeding into broader input costs. Markets are effectively pricing a hit to global growth of roughly three-quarters of a percentage point alongside higher inflation. That is why yields have risen and why expectations for Fed cuts have faded so quickly. Energy is now influencing the entire market conversation. This does not look like a full return to the inflation spikes of 2022, but it does add pressure at a time when inflation had not fully settled back to target. That means investors can no longer assume lower rates will quickly rescue every market pullback. In this kind of backdrop, quality matters more. Companies with pricing power, durable demand, and healthy cash flow tend to be better positioned. We are seeing earnings growth starting to spread out to more companies beyond the Magnificent Seven. The remaining 493 companies in the S&P 500 are projected to post double-digit earnings growth for the first time in several years. In other words, this is no longer just a story about a handful of giant technology names carrying the market. There are more pockets of real opportunity opening up across sectors and industries. So, what does smart positioning mean today? It means staying invested, but being more selective. It means looking beyond a crowded winners and paying attention to value, dividend payers, and quality businesses that may benefit as leadership broadens. Value stocks were trading at a 43% discount to the market in February, compared with a 19% historical median, which suggests some attractive re rating potential if the rotation continues. Artificial intelligence remains one of the most important long term themes, but the opportunity set is widening. It is no longer only about the obvious names. More of the opportunity may be found in the infrastructure behind the theme, including semiconductors, power, and data center assets. In fact, data center could consume 15 to 20% of US electricity demand by 2030, showing how large this buildout may become. This environment also changes how diversification works. Long dated treasuries have not provided the same protection many investors once expected, and markets are rewarding more deliberate portfolio construction. That means relying less on old assumptions and working on more flexibility, shorter duration fixed income where appropriate, and themes that can work across multiple scenarios. A more active mindset matters more when the market is changing this quickly. My role is not to react emotionally to every headline. My role is to stay disciplined, study what is changing, and position your portfolio with care. Right now, that means respecting inflation and geopolitical risk, while also recognizing that market leadership is broadening and earnings opportunities are expanding. I remain focused on protecting downside, participating in growth, and keeping your long term goals at the center of every decision I make for you. Thank you, as always, for your continued trust and confidence.